Have you ever wondered about the biggest financial crises in history? Today we delve into the archives of financial history. Picture the global economy as a ship sailing through time. Occasionally it encounters tumultuous storms known as financial crises. These crises, often triggered by a complex mix of economic, financial and political factors, have the potential to capsize the ship, causing ripples of economic hardship that can extend far and wide. In this video, we'll be exploring 5 of the most significant financial crises the world has ever seen. We'll start with the Great Depression, a severe worldwide economic downturn that took hold following the Wall Street crash of 1929. From there, we'll move on to the OPEC oil price shock of 1973, the Asian financial crisis of 1997, the dot-com bubble of the early 2000s, and finally, the global financial crisis of 2007 to 2008. Hold on to your seats as we journey back to the year 1929, to the start of the Great Depression. The year is 1929 and the world is about to experience the most severe economic depression in history. This was the era of the Great Depression, a time that would forever change the face of global economics. Let's take a step back to the end of October 1929. The Wall Street crash sends shockwaves around the globe. Billions of dollars are wiped out in mere days as the stock market crumbles, a stark contrast to the roaring 20s, a time of prosperity and optimism. This sudden crash was like a bucket of ice-cold water, throwing the world into a chilling reality. As the stock market crashed, banks started to fail. With no federal insurance to back them up, the banks' failures caused a ripple effect. Millions of people who had trusted their life savings to these institutions found themselves penniless. The domino effect was in motion, and there was no stopping it. As banks crumbled and businesses shuttered, the unemployment rate skyrocketed. By 1933, nearly 1 in 4 Americans were out of work. It wasn't just an American problem, though. From Europe to Asia, from Australia to South America, no corner of the world was left untouched. This was a global crisis, the likes of which the world had never seen before. But as with all crises, the Great Depression wasn't just a time of economic despair. It was also a time of innovation and reform. Governments around the world were forced to intervene, establishing new policies and regulations to prevent such a catastrophe from happening again. This period saw the birth of economic theories and practices that are still in use today. The Great Depression was a dark time in our history, but it was also a turning point. It pushed us to rethink our economic systems, to strive for stability, and to learn from our mistakes. It was a harsh lesson, but a necessary one. It showed us the devastating power of economic collapse and the importance of safeguards to protect against it. The Great Depression set the stage for economic reforms and policies that still impact us today, but the world was yet to experience the shock of 1973. Fast forward to 1973, and the world is shaken by a drastic increase in oil prices. Imagine this. The world, still recovering from the wounds of the Second World War and the Great Depression, was about to face another significant financial crisis. This time, the crisis didn't originate from the stock market or a housing bubble. It came from oil, a commodity that had become the lifeblood of the global economy. In the early 1970s, the Organization of Petroleum Exporting Countries, or OPEC, decided to flex its muscles. The Middle East had become the world's chief oil exporter, and OPEC, primarily led by Arab nations, held significant control over the global oil supply. This group of oil-rich countries made a decision that would send shockwaves around the world. They dramatically increased oil prices. This wasn't just a mere price hike, it was a quadrupling of prices, a move unprecedented in the history of the oil market. But that wasn't all. OPEC also declared an oil embargo against several Western countries, including the United States, which had supported Israel during the Yom Kippur War. Suddenly, the world was plunged into an energy crisis. Gasoline became scarce, prices at the pump skyrocketed, inflation soared. Economies reliant on oil imports, particularly the United States and Europe, were hit hard. They plunged into a recession, struggling with unemployment and stagnation. The impact was felt not just in economic terms, but in geopolitical and societal spheres as well. In response, many countries started to rethink their energy policies. They began to explore alternative energy sources, driving advancements in nuclear, solar, and wind power. The crisis also led to a greater focus on energy conservation and efficiency. But the OPEC oil price shock didn't just lead to changes in energy policy. It also changed the global economic landscape. The oil-producing nations grew wealthy, while the oil-dependent economies faced years of economic struggle. The balance of economic power shifted, highlighting the vulnerabilities of the global economic system. The oil price shock of 1973 reshaped the global economy and energy policies. However, the financial crises were far from over. The world had to navigate through these stormy waters, learning valuable lessons about reliance on single commodities and the need for diversity in energy sources. The world barely recovered from the oil price shock when the Asian financial crisis hit in 1997, soon followed by the dot-com bubble. In the late 90s, the world's economic stage was set for a tumultuous performance. The Asian financial crisis began in Thailand, a country that had been a beacon of economic growth. However, the beacon began to flicker when the Thai government was forced to float the baht due to lack of foreign currency to support its fixed exchange rate. This, coupled with the country's foreign debt, caused the baht to plummet, and the effects rippled out, leading to severe currency devaluation and capital flight in several other Asian countries. The crisis was a stark reminder of how interconnected the world economies had become. International Monetary Fund had to step in with a rescue package to stabilize the economies, but the damage was done. The crisis left lasting scars on these Asian tigers, causing a slowdown in their economic growth. While Asia was grappling with this financial turmoil, another bubble was inflating on the other side of the world. The advent of the internet had given rise to a new kind of business, the dot-coms. Buoyed by the promise of the digital age, investors poured money into any business with a dot-com in its name, valuations soared, and the stock market danced to the rhythm of this new tune. However, by the early 2000s, it became clear that many of these internet companies were not profitable. They were burning through cash with no clear path to profitability. The party had to end, and when it did, it was a sobering moment. The bubble burst and the stock market crashed, wiping out trillions of dollars in market value. These two crises, one in the East and one in the West, served as poignant reminders of the risks inherent in financial markets. They underscored the importance of sound financial practices and the dangers of speculative bubbles. While the world was still reeling from the Asian financial crisis and the dot-com bubble, another crisis was brewing on the horizon. In 2007, the world was hit by the global financial crisis, triggered by the collapse of the US housing market. The crisis was the most serious financial meltdown since the Great Depression. It all began with a boom in the US housing sector, fueled by low interest rates and lax lending standards. Banks and other financial institutions began issuing a high number of subprime mortgages, loans given to borrowers with low creditworthiness. These risky mortgages were then bundled into complex financial products called mortgage-backed securities. When the housing bubble burst, the value of these securities plummeted, leading to significant losses for financial institutions around the globe. The crisis deepened as major financial institutions faced insolvency. In the United States, investment bank Lehman Brothers filed for bankruptcy, marking the largest bankruptcy filing in American history. This sent shockwaves through the global financial system, causing the collapse of several other major institutions and forcing governments worldwide to intervene. The US government implemented a series of bailouts and stimulus packages, injecting trillions of dollars into the economy to prevent a complete financial meltdown. Other governments followed suit, propping up their own struggling banks. The crisis also led to a severe global economic downturn, with stock markets around the world experiencing significant declines. Unemployment soared as businesses shut down, and the crisis pushed the world economy into a deep recession. The global financial crisis highlighted the vulnerabilities in the global financial system and the dangers of excessive risk-taking. It led to significant regulatory changes aimed at preventing a similar crisis in the future. The crisis underscored the interconnectedness of our global economy. Problems in one part of the world can quickly spread, leading to a domino effect of financial instability. The crisis demonstrated the potential for rapid financial contagion, a phenomenon where financial shocks spread from one country to another, much like a disease. The global financial crisis was a stark reminder of the interconnectedness of our global economy and the potential for rapid financial contagion. From the Great Depression to the global financial crisis, The world has experienced several financial crises that have reshaped economies and policies. The Great Depression taught us about the dire consequences of excessive speculation and weak financial regulations. The OPEC oil price shock underscored the vulnerability of global economies to sudden shifts in commodity prices. Then came the Asian financial crisis, a stark reminder of the dangers of over-reliance on foreign capital and the volatility of currency markets. The dot-com bubble burst showed us the risks of overvaluing assets based on hype and speculation, rather than solid financial performance. And finally, the global financial crisis demonstrated the potential for housing market collapses to trigger widespread economic turmoil. Each of these crises has left an indelible mark on our economic landscape, influencing policy decisions and financial strategies. They serve as cautionary tales, reminding us to be vigilant, to question, to learn, and to adapt. As we navigate our financial futures, we must remember these lessons from our past, because those who do not learn from history are doomed to repeat it.